Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of all the corporate jargon and financial mumbo jumbo for you today. We are diving into Able Inc.'s latest filing, which is a current report telling us about some pretty important changes that just happened. Think of it as a quick update from the boardroom about a big deal they just signed. Before we jump in though, if you love getting these corporate secrets unlocked without the boring parts, make sure you hit that subscribe button. And if you want to chat with us and other finance enthusiasts, join our Discord community. It's linked right down in the description. So what is this report all about? It's basically a heads up that Able Inc.'s indirect wholly owned subsidiary Able International Holdings, the C, also known as the borrower, entered into a new deal called Amendment Number 2 to their credit agreement. Now this might sound dry, but trust me, it's not. This is like getting a new loan or changing the terms of an old one, and it can tell us a lot about how a company plans to grow or manage its money. What did this Amendment Number 2 actually do? Well, the big news is they increased the total amount of money they can borrow under something called the term loan facility. Before this deal, the most they could borrow was $336 million. Now they can borrow up to a whopping $400 million. That is a significant bump up of $64 million. They are clearly looking to fund something big or maybe multiple things. They also extended the deadline for paying back this term loan. Instead of having to pay it all back by a certain date before now, they have more time, pushing that deadline all the way out to the 26th of November, 2032. This is great news for them because it gives them more breathing room to generate earnings and pay off their debts. And it is not just the term loan. They also extended their revolving credit facility, which is like a credit card for businesses. The deadline for that one is now the 26th of November, 2030. They also managed to get a lower interest rate on this revolving facility, which is always a win. So what is all this extra money for? They mention a few things. One, they want to fund deferred payments from their acquisition of Adlumin, incorporated back in November of last year. Acquisitions are a big part of how companies grow, so this shows they are still focused on expanding through buying other businesses. They also say they will use it for future permitted acquisitions, which means they are keeping their options open for more buying opportunities. Then there are share repurchases, which means they plan to buy back their own stock, which can sometimes signal confidence from management or be a way to boost the stock price. And of course, paying for related fees and expenses. Now let us talk about the cost of borrowing that money. For this revolving credit facility, the interest rate will now be a floating rate based on something called SOFR or Euribor plus a margin. Initially, that margin is 2.50%, but it can go up to 2.75% if their net leverage ratio, a measure of how much debt they have compared to their earnings, goes above 2.50 to 1. For the term loan, the interest rate is also floating based on SOFR. The initial margin here is 2.75%. However, it can go down to 2.50% if their net leverage ratio is 1.65 to 1 or lower. This is a pretty common way banks structure loans. They reward companies that manage their debt well by giving them lower interest rates. As of the date of this filing, the interest rate for US dollar borrowing under the term loan was 6.59%. And importantly, they had no money borrowed on their revolving credit facility at this time. This means they are not relying on that credit card for day-to-day operations right now, which is usually a good sign. Repaying this massive term loan will happen gradually. They will make quarterly payments equal to 0.25% of the original loan amount, starting on the 31st of March, 2026. The rest of the balance will be due when the loan matures. This structured repayment plan helps them manage their cash flow effectively. One last thing to note is that the banks involved in this deal have a history of doing business with Able Inc. and its affiliates. They have provided services like investment banking and lending. This is normal in the corporate world and means these banks have a vested interest in Able Inc., doing well since they are also lenders. So let us put on our analyst hats and look at this. Able Inc. is clearly in an expansion mode. They are not just borrowing more money, they are also extending their repayment deadlines, which tells us they are confident in their future ability to generate enough cash to cover these obligations. The increase in the term loan facility from $336 million to $400 million is a significant move. It implies a strategic decision to either fund larger acquisitions, grow organically through investments, or perhaps increase shareholder returns through buybacks. On the flip side, anytime a company significantly increases its debt load, it is a signal for us to watch closely. While they have pushed out their maturity dates, effective debt management is key. The interest rate structure with margins tied to their net leverage ratio is a good incentive for prudent financial management. If their leverage ratio creeps up, the cost of borrowing effectively increases. The fact that they are using some of this new funding for deferred payments from a past acquisition suggests that those acquisitions are integrated into their growth strategy and require ongoing financial commitment. It also means they are not afraid to allocate capital to growing their business. Now, for N-able Inc. Specifically, they operate in the IT management software space, which is a competitive but growing market. Companies like this need to constantly innovate and acquire capabilities to stay ahead. This increased borrowing capacity could be a direct response to opportunities they see in the market, perhaps a larger acquisition target or a strategic investment in a new product line. The biggest risk here is not necessarily taking on debt, but what they do with that debt. If these new funds are deployed effectively into revenue-generating assets or strategic acquisitions, then this move could be a major catalyst for growth. However, if the investments do not pan out or if market conditions shift unfavorably, then this enlarged debt burden could become a significant challenge. We will be looking for updates in their future filings to see how this capital is being deployed and what results it is generating. In conclusion, Able Inc. is making a bold financial move to fuel its growth. They are leveraging debt to pursue strategic objectives, and their extended repayment terms provide flexibility. The key will be their execution and ability to generate returns that justify this increased financial commitment. We will continue to watch them closely to see if this bet pays off. Alright, that is our deep dive into Able Inc.'s latest report. What are your thoughts on this borrowing increase and what it means for the company's future? Let us know in the comments below. If you found this breakdown helpful, give us a thumbs up and subscribe for more corporate insights. And seriously, check out the Discord linked in the description. It is a great place to connect. Thanks for watching, and we will see you in the next video.